Hey, what's up, guys? John here. Some interesting things are happening right now with the Fed, with the Federal Reserve, the banking system, the economy. We're going to talk about this because I think what we're going to start to see here is something really big happen, something we've never seen before. I think that this is going to get out of hand. I think it's going to get out of hand quickly. I'm not saying this to scare anybody, but in this channel I talk about personal finance, real estate, business, and money. And if we're not looking at the facts, we're not removing emotion. I know a lot of people are injecting emotion, fear, and this and that into the economy. Just look at the pure facts. Look at the structure, the actual foundation of this economy, and where we truly stand, where the banking system stands, and what Jerome Powell is doing on one hand, but what they're actually doing behind the scenes that I believe is going to be the big problem. Sure, the interest rates are a big problem, but what's happening behind the scenes is what we all need to pay attention to as well. I think we're going to see massive investing opportunities. So if you want to invest in distressed real estate, you want to grow and expand a business, there's going to be a lot of opportunity, but I think there's also going to be a hell of a lot of pain coming to this economy, far worse than anything that we've seen in a very long time. I think it's going to be worse than 2008. But I'm going to walk you through what's going on. Please hit the like button. When you hit the like button, YouTube's going to share this content to educate more people about what's really happening in the economy. And if you want to fix your credit so you can invest and get distressed real estate deals potentially and get really good financing, we'd love to help you and be a part of that and help fix your credit at GreatCreditFast.com. That's GreatCreditFast.com. Or if you'd like to do a balance transfer, get out of high interest credit card debt, need good credit to do it, we'd love to be a part of that as well. GreatCreditFast.com. Take a look at this. So Fed, and if you look, and our phone number as well is 561-430-5900. So Fed hikes rates by a 0.25 percentage point, indicates increases are near an end. The Federal Reserve on Wednesday enacted a 0.25 percentage point increase rate, expressing caution about the recent banking crisis and indicating that hikes are nearing an end. Now, you remember Jerome Powell about 4 months ago, he said that they're going to continue to increase interest rates until something breaks. Well, Signature Bank broke. Silvergate Bank broke. Signature Bank broke. You have the UBS situation. UBS acquired Credit Suisse for $3.2 billion with the help of the Swiss national government. I would consider that a break. And then you also have Republic Bank. Like you've seen what's happened to their shares. Republic Bank is in very big trouble. And there's some other banks as well that are stepping into problems, right? So I would consider that all, a clear sign that something is breaking. But yet they're going to continue to increase interest rates. They say one more hike is coming. I personally think that it wouldn't surprise me to see 2 or 3 more hikes this year coming, especially when you consider what's happened. 9 hikes in the last 12 months. 9 hikes in the last 12 months. The rate-setting Federal Open Market Committee noted that future increases are not assured and will depend largely on incoming data. The committee is closely monitoring incoming information and assesses the implications for monetary policy. The FOMC post-meeting statement said the committee anticipates that some additional policy firming may be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Now you have to ask yourself, what would it take to get inflation to 2%? Well, if you believe the inflation numbers that they're giving us now, I personally think that those numbers are off. I personally think that inflation data is probably in the double digits. But if you do believe it at 6% or 7%, to take it to 2%, the cost of goods would have to come down. Everything would have to come down. And one of the main things would be energy costs. But yet they're talking about energy costs, gas prices going up 60 cents or more by Memorial Day. So if you have gas prices going up 60% by Memorial Day, and you have inflationary procedures, such as the Fed putting in $300 billion in liquidity, and then also inflationary programs where they're talking about potentially doing $2 trillion to infuse the banking system, or an infusion of $2 trillion in the banking system, you have to ask yourself, how? How does this work? You increase interest rates, meaning the cost to service debt is more and more expensive, which obviously is going to impact consumer spending because they're going to have less money to spend because they're going to be spending more money on interest to service the debt. And then you put more money into the ecosystem. So obviously things are likely going to continue to rise, especially as energy prices continue to rise. So they are not doing something that I would believe is going to be something that is going to draw inflation down. Instead, what it's going to do, it's going to draw the lifestyle down for most Americans. The quality of living is going to come down. That is for sure. Especially when you start to look at how banks are structured and what's happening right now. just in the U.S. housing market, 40% of all U.S. mortgages were between 2020 and 2021. That's pretty crazy. About 12 million home sales occurred during that period. 40% of all U.S. mortgages. Significant. That also, you have to take into consideration, it doesn't include refinances or anything like that. That's also considered a mortgage. So 12 million sales occurred during those 2 years, plus basically everybody refied their house. So banks are making tons and tons of money on banking fees, on loan origination fees, on interest. They were making off like bandits. Now what's starting to happen is when we look at the fundamentals of those mortgages, first-time home buyers, the average down payment 6%. The average down payment of a second home was, I think, 13% or 12%. So the average between both about 9%. The cost of sale, selling a single-family home, probably somewhere around 7%. 5% goes to listing and buyer's agent. And then you have fees that are attributed to closing costs, escrow, transfer taxes, stuff like that. So when you take mortgage rates from 3% to 7.5%, you essentially remove any liquidity in those properties, on the average property. And so as that is happening, banks are then sitting on a bunch of bad loans. So they don't have the loan volume, they don't have the origination fees coming in, they are sitting on bad loans. Their bonds are becoming worthless as interest rates are continuing to rise. Borrowers have less money because they're spending it more to service debt. You know, as Ken Griffin said, there's $1 trillion in consumer funds, and they're burning about 110 to 120 billion a month. So within a few months, he believes that they're going to run out of money. As that's happening, look at the auto loan situation. Auto loan situation, 1.6 trillion in outstanding auto loans, a lot of which are upside down, spending 30% over sticker price. And the same situation is going with commercial real estate. It's a $20 trillion market. Half of that debt, half of the mortgages are floating rate. So you have increased vacancies, you have decreased net operating income and increased insurance and property taxes. Well, that's a problem as well. So you're starting to look at the balance sheet of banks. They have less cash on hand, they have way more liabilities, and their investments that they made over the last few years are worth less and less and less. And they're going to have to realize those losses. As of now, they're unrealized losses for many banks, but that could soon very well change. The wording in a departure from previous statements, which indicated ongoing increases would be appropriate to bring down inflation. If they wanted to bring down inflation, I mean, here's how I would do it. I would open up a lot of energy in America. That's what I would do. I would draw down energy prices and get these energy prices back to $2 a gallon, bring down diesel prices. I would do things that are going to allow businesses to produce service or products and services and things to consumers for less, so we can start to draw down the cost. I wouldn't be doing things such as, let's increase the cost of energy. Let's make things harder. I would try to do things that are going to kind of give a buffer to the economy and draw down the cost. But they're not going to do that. They've spoken very clearly about this, that they are going to be moving us into a direction of clean energy, which is actually going to be very costly and likely inflationary. The softening tone came amid a banking crisis that has raised concerns about the system's stability. The statement noted that likely impact from recent events. The U.S. banking system is sound and resilient. Words like that from them make me believe it's probably not. Especially when you look at just what's happened in the last couple weeks. I think a lot of people would start to say that you don't really know what bank is sound and resilient. I'm not saying any of them are going to collapse. I'm not trying to, no fear. But if you just simply look at it, Signature, SVB, Silvergate, the situation of Credit Suisse, you start to look at it, you have to ask yourself, well, how many other banks are on the verge? And what is this quarter point going to do? Is this quarter point going to push more banks off the cliff's edge? And they said there's going to be another hike coming. Is it going to be one more hike or two or three? We don't really know, right? And so that's why I think it's important to position yourself into a place to where you're out of consumer debt, high interest consumer debt, because this quarter point interest rate hike means that your credit cards are going to cost you more interest. Everything adjustable is going to cost you more interest. So getting out of high interest credit card debt is going to be very, very important. And positioning yourself for distress. Recent developments are likely to result in tighter credit conditions for households. And this is another thing I've been speaking about very clearly on this channel, saying that if you have credit card debt, you have debts, this is the time to fix your credit, because as banks start to get more skittish and scared, there's going to be tighter and tighter and tighter credit conditions. Meaning, you're going to need to show stable income, you're going to need to show great credit, you're going to need to show that you are an A-plus borrower on paper. But as of right now, there's still tons of offers. So like in the next month, 2 months, you'll probably be able to realize, or maybe even 3-4 months, be able to realize some of these offers potentially. But in a year, I would bet a lot of these offers start to fade away. It says, recent developments are likely to result in tighter credit conditions, households and businesses, and to weigh economic activity, hiring, and inflation. The extent of these effects is uncertain. The committee remains highly attentive to inflation risks. Despite the warnings about potential implications from the banking crisis, the committee unanimously approved a rate hike. The increase takes the benchmark federal funds rate target range between 4.75% and 5%. The rate sets what the banks can charge each other for overnight lending, but feeds through a multitude of consumer debts like mortgages, auto loans, and credit cards. You know, credit cards right now are the highest they've been in 30 years, credit card interest rates. The last thing you want to do, if you borrow $5,000 on a credit card and you're making the minimum payments and you're telling yourself, hey, I can afford the minimum payments, it's like you're probably spending, you're borrowing $5,000, you're probably paying back $15,000 or $16,000 in total. So you're spending $10,000 or $11,000 in interest alone, which could be invested. You could put that into your education or a real estate investment, paying off your car, whatever you want to do. But it's going to feed through all of these things. And who is this going to benefit? It's going to benefit the ones that have, that are well positioned for it. Because you think about what is going to happen. They're going to run out there and pounce on these distressed opportunities. A lot of private equity firms, a lot of people, a lot of institutions, family offices, they're sitting on cash. They know that consumers are against the wall and they're going to need to start selling things. Projections released along with the rate decision point to a peak rate of 5.1% unchanged from the last estimate in December, and indicative that a majority of officials expect only one more rate ahead. Well, do you think they're going to bring, if they're saying inflation's, in the mid sixes right now, do you think that one more rate hike? They said that we were at 8 or 9% and we did 9 hikes in 12 months. Do you think one more hike is going to get us from 6% to 2% or 3% or 4%? No, I don't. And I think they're going to continue to push it out and say one more, right? Data released along with the statement shows that 7 of the 18 Fed officials who submitted estimates for the dot plan see rates going higher than the 5.1 terminal rate. The next 2 years worth of projections also showed considerable disagreement among members, reflected in a wide dispersion among the dots. Still, the median estimate points to 0.8 percentage point reduction in rates in 2024, a 1.2 percentage points worth it in 2025. Now, a lot of people are taking on adjustable mortgages, home equity lines of credit, based on the notion that they are going to decrease interest rates at the end of the year or in 2024. That is very well possible. It's likely. They could, but they could not, right? So you have to ask yourself, a really smart investor said, once told me, the difference between a really, really good attorney and a basic attorney is that a good attorney is one that is looking and more fearful of the risk than the upside. And the other attorney is the one that's only looking at the upside and not paying attention to the exposure, right? And I feel like that investor, when he was talking about the attorney, I think that is very applicable to a smart investor in today's time. You really want to pay attention to the downside risk, probably even more so than the upside. If you can assume the downside risk and you can eat the downside cost if things go south, then you're fine, right? But if you can't, then the whole ship goes down, and that's not worth chancing. You just don't know what they're going to do and how this whole thing's going to play out. The statement eliminated all references to the impacts in this situation here. Now, I'll leave this below. I'm not going to read the whole thing, but I'll leave this below. You can take a look at this. Tell me what your thoughts are on this entire situation. Where do you see this going? Where do you see them stopping increases on interest rates? And what do you think is going to be the impact to this economy? Drop below, hit the like button, subscribe here. And on my second channel, it's Interactive Call and Show and a podcast. I have a new studio coming, so we're going to have a bunch of live guests coming in, so be sure to subscribe over there. And again, I'd love to help you fix your credit at GreatCreditFast.com. That's GreatCreditFast.com. And give us a call at 561-430-5900, and I'll catch you guys in the next video.